All right, so hey guys, how's it going? My name is Antonio Cabral, if you don't know who I am. I get a huge boner talking about investments, financial stuff. It makes my girlfriend go to sleep, so that's really cool. So I hope what I can teach you is beneficial for you. At the beginning, I have to say that I work for a financial institution, so everything I say regarding investments is my opinion and my opinion only. Does not reflect anything that Bank of New York Mellon does or say or whatever. So it's just all purely my opinion. So the first thing we're going to talk about is debt. So let's see, there's 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12. So 12, 7 out of 10 people graduating today will have debt. The national average for debt for a graduating student is about $30,000. It's above that. So that's really expensive. So you're going to experience debt. It's just a fact of life. But debt isn't always bad. It can be good, and we'll explain that later. But there's some current statistics. 8 in 10 Americans are in debt, and that's ranging from 18-year-olds to 70-plus-year-olds. So you're not alone in being in debt. And the majority, 21%, is student loans, but just for millennials, it's 41% of all millennial debt is just student loans. So this is the first time that we have a lot of student loans for one generation. And if you want to wonder why we got into this predicament, John Oliver has a great video on student loans, but basically it boils down to 90% of all student loans is given by the government, budget gets cut, and they ask the tuitions to be raised for the schools. And then you have to take out more loans. So that's how we got here. 1.2 trillion is just in student loan debt right now owed. That's unpaid. So, well, what do you do with debt? You're going to have it for the rest of your life. So what do? You have to manage it. So one easy strategy is to pay it off. Some credit cards, like American Express, do not roll over accounts, so you have to pay it off. But some debt is something called a rolling balance, which every month the balance just rolls, and interest is accrued, so that you would just have to pay. Never be late on a payment. That's something very, very important to understand. Never be late on a payment. And one thing that you have to pay attention to is with your debt is to manage your debt, you have to pay the most expensive debt first. So if you have a loan of $7,000 with an interest rate of 3%, and a $1,000 debt with 7% interest rate, you're going to have to pay the $1,000 one first because it has a higher interest. Then you pay the next one because the interest is accrued on the principal. So if you have $1,000 and you knock it down by $400, well then the next payment, the 7% is only accrued on the $400, like the remaining balance. So you want to knock down the most expensive debt first. And a great way to help you to budget with debt is just create a calendar and just say I owe this one day, owe this another day. Most lenders will work with you. So in my student loans, I got to pick the day that I got to pay. So I have it on the 4th of every month, and I pay on the 4th, and I also pay one more time in the middle of the month, so then I make sure I don't skip a payment or I don't automatically default on a payment. Where am I? I got lost, sorry. So set up your calendar. Always make sure you pay on time. And one thing that you have to note is if you don't like all your debts being paid on the same month, you can move them. And you could have it spread out from one paycheck to another paycheck. And that could help you balance your debt and manage your debt. So there is student forgiveness programs, but it only applies if you're a teacher, which if you're a teacher, right, for you, or if you work in a federal, state, or local government, and it has to be a full-time employee, or you could work for a nonprofit that's categorized as a 501c3. If you work for that, if you work 10 years and you make 120 payments, so basically one payment a month for 10 years, you could apply and qualify to be forgiven of all the remaining loans. So that's something really, really cool and incentive to work for nonprofits. Now, if your income-based payment is basically where if you make low income, the higher income you get, the more you have to pay over a period of time. If you spent anywhere between 20 to 25 years, you could have that all expunged. But you have to meet some certain criteria, and it's designed primarily for low-income workers with a really, really high debt. And then the next one is teachers' loan forgiveness, and that one is only given to low-income schools. And you would have to access a website that will tell you if your school is in a low-income neighborhood. And all these apply to most federal loans, except for the teachers. It doesn't apply to your PLUS loans. So if you have PLUS loans, you're kind of out of luck. Now, consolidating loans. Consolidating loans is basically when you have a lot of debt. You have, let's say you owe AT&T something, you owe Best Buy something, you owe like Target something, and you're getting really, really swamped with all these payments. What you could do is go to a bank and ask, I want a loan for X amount. And they'll give you a loan. You pay off your debts with that one loan, and you just pay off that one loan. Now, the bad thing that could happen is that if, let's say, one of your payments was 2% interest, and now the loan that the bank gives you is 5%, well, you're paying 3% more. So the whole purpose of consolidating loans is to make sure you get the lowest payment available at the lowest interest rate. And that's the only way and the only reason why you should ever consolidate your loans, is to minimize that payment. Oh, no, wrong one. Yeah, it says unconnected. Oh. Thought I had more pull. All right, so the next one is that what happens if you can't consolidate your debt? What happens if you're way too knee and deep in Shake Creek, essentially, with debt? You could bankruptcy. You could call for bankruptcy. You never want to do this, ever. You don't want to be Trump, and you don't want to pull bankruptcy. Your bankruptcy will ruin your credit, and it can take a long time to establish your credit from bankruptcy. There's two types of bankruptcies that are eligible to individuals, Chapter 7 and Chapter 13. Chapter 7 basically just liquidates everything. That doesn't mean that they take your house and they sell it. No, most Chapter 7 bankruptcies keep their house. It's just selling off any other assets that you have. And then you just give it to all the debtors, and then they'll just absorb the losses. And that's it. But it impacts your credit score and credit history a lot. Then there's Chapter 13, which basically just allows you to pay one payment a month for all the debt you own for a certain time frame. So 3 to 5 years. There's 3, 5, 7, 10, depending on where you go. And this just basically manages it better. Now, Chapter 13, the only reason why would you ever bankrupt is you want to get a lower payment. Same thing as consolidating loans, but a bankruptcy allows you to actually wipe away some debt. So let's say you have student loans. Let's say you have $120,000 in student loans, and you go with Chapter 13. Well, you could pay those monthly payments, but after a certain period, after those 5 years, whatever you pay, that's what you pay. So if you only paid $12,000 out of those 120, well, then that's all you pay, and then the rest is just expunged. So sometimes it works, but I would highly recommend never, ever to do bankruptcy. It's a last resort, but it's a financial it's a financial solution for those that can't handle their debt. Now, the next one is credit. What credit is basically just a trust between a lender and a borrower. It's basically just saying, hey, I can pay this. And this applies for home, auto. It could apply for a job. If you actually apply for a job, sometimes they actually look at your credit to see if you have good credit, because they think good credit is associated with good job performance, which really doesn't mean that, but some employers do that. Basically, it's kind of like getting a job. You need credit to get credit, and it kind of sucks because people of your age. But there's lots of ways that you can get credit, and some of you already have credit without even realizing it. basically, credit is very important in your daily life. It can increase wealth. Now, wealth does not mean money. Wealth basically means personal assets that creates your net growth. So it's a house, it's student loans, because that could be considered an investment. So credit is very important, and it could actually make your life cheaper. So basically, your life will be ruled by this number. My life is already ruled by this number, and I hate it, but it's already ruled by it. Basically, a FICO score is basically your credit score. There's two types of credit verbiages. There's credit report, which is all your entire history of all your accounts that you've ever opened, all the checking accounts that you've ever opened, all the inquiries that you've ever done for the past year, how old your credit is, and everything. So your FICO score is something completely different. It takes all those parts in your credit report and compiles one number between 300 and 850, and that is your credit score. So 35% is payment history. Have you ever defaulted? Have you ever defaulted? Have you ever done a bankruptcy? Have you ever done foreclosures? Have you ever been passed a judgment? That can affect it. It's 35%. So that's why I always say never be late on your payments and never bankrupt. Never go bankrupt. Next one is total debt. It's 30% of your total debt. 30% of your FICO score is based on your total debt. This can mean your credit utilization ratio, number of accounts that have a balance on them. Credit utilization ratio is basically if I have a credit card that's that's 10,000, and I have 3,000, that's utilization of 30%. You never want to pass a credit utilization ratio of 30%. If you're going to pass 30%, either put it on a different card, use emergency funds to pay for it, but you can put it on the credit card, but it's highly suggested that you don't pass your credit negatively. Because it basically, when they look at total debt, they look at, okay, how much debt you have and how much more debt can you take on. Length of credit history affects all of you. You barely have credit, you probably have 1, 2, or 3 years of credit, and that impacts you negatively. But how you can offset that is by making payments. Because you can see that the new credit is way lower than the payment history and the total amount of debt that you have. Now, unfortunately, student loans does go and factor in total debt, but it's appropriated differently. So the FICO score takes into account student debt as a slightly different debt. So, and then the last 10% is the types of credits you use. If it's a credit line from a store, if it's a credit card, if it's an auto payment, anything like that. Now, to improve your credit, the first thing you should do is check your credit report, and you could go to annualcreditreport.com and you could get one for free. It looks like it's a sketchy-ass website. It looks like it's illegal, like someone from Cambodia basically just made it and says, here's your credit history, give me your social security number, and I'm going to fuck you over. It's not that. It's an actual website created by the 3 creditors, Equifax, TransUnion, and, oh, fuck's the other one, Quirion? That's 2. And then you could also ask them, you could pay for your FICO score from annual credit report history, or you could go to My FICO and get a credit report. Or what you could do is some credit cards now allow you to look at your FICO score. So I'm just going to look at my FICO score and show you how it looks like, if this ever works. And it's for free. So checking your credit card score sometimes can be for free. If you're going to buy if you're going to buy a car, if you're shopping around for rates, it doesn't impact your credit score negatively that much. But if you commit to one, then it impacts it, and that's called an inquiry. It's better to shop around than just to grab the first loan that you can. So with Bank of America, they have this deal where they actually communicate with FICO, and I just click View My FICO Score, and that's what I'm at right now. And it's at 763. So it's good. I was in the 800s, but then I applied for a new credit card, and Now it lowered it because I opened a new account. So one example to give you a perspective of how FICO score works, I got my first credit card when I was 18 years old. It was co-signed by my parents, so I had no credit. And they co-signed it, and I got a credit card. I used it. I only made small purchases, so like gas, groceries, anything small I could make, and if I had the money for it. So then I would just pay it off automatically. That credit card has 24% APR, so that's after a whole year, that's how much interest is going to be charged on that card. That's extremely high. A couple of months ago, I went to London and I needed to get a new credit card, one that doesn't one that doesn't charge me for every single time I use it overseas. And now this one is only 17%. So because I had a higher credit score now than I did back then. So your credit score can affect you and make your life cheaper in a sense. How to build credit? Checking accounts are actually a good, healthy way to establish credit. It doesn't establish credit, but it's confusing as fuck. You basically, when you pose for an inquiry, they want to see if you have any money. So they have to look at your credit, at your checking account to see if it's even like there. And then from there, then you could build your credit. Many ways to build your credit would be student loans. Debt is a sort of building credit because you're making payments and you're basically building that credit and that relationship with lenders. You could apply for a department or gas card. You could apply for a secured credit card. If you don't know what a secured credit card is, it sounds weird, but it's not as shady as you think. So it's basically kind of like a debit card, but it's not a debit card. You go to Discover and you pay them $300. They give you a credit card with $300 account limit. You use it, you pay for it, whatever. Once you're done with that card, you could return it to them and they'll reimburse you those $300. It's basically a way after 2008 to make sure that banks and financial institutions don't get screwed over by people that can't pay back the credit and then affect other people in the process. And then now is for investments. Now, there's a lot of investments, and I'm going to try to explain each one. So the first one is stocks. The only reason why you would ever make investments is to make your money work. So the first one is stocks. Stocks is ownership of companies, and you could buy like Apple, Microsoft, give me another one. Google, you could buy Google if you're really rich. Yahoo, well, you don't want to buy Yahoo now. Actually, depending on who wins tonight, if Trump wins, the stock is supposed to plummet like at least like 300 points. So we'll see. So basically, stocks are volatile. They change constantly, daily. It's frustrating if you're a day trader. It can be rewarding, but stocks offer high rewards with high risk. There's always a correlation. The higher the reward, the higher the risk. The lower the reward, the lower the risk. Some stocks pay dividends. Apple, for a long time, I hated, and I still hate them, but they didn't pay dividends. They had all this cash, but they never paid dividends to their investors. Recently, now they start paying dividends. Dividends is a way that you can reinvest money back into that stock or just keep it for yourself. So let's just say, like in my own fund, I have clients that receive a dividend. And when a client has a couple thousand of shares, their dividend could be as high as millions of dollars. So if you invest a lot, your dividends are only 25 cents per share, but over a lot of stock that you own, they could actually increase and they could become 250 or 2,000, depending on how much you invest. The next one is, the next type of investment is bonds. Bonds is basically debt. You're basically purchasing the debt of companies or governments, and they will pay you back in full plus interest. This is the most safest way to invest. You will not lose any money unless for some odd reason like Trump decides to blow up the government. Or if anything were to happen to the government, then the bonds won't be able to pay back. Bonds are the safest way to invest, but they take a long time. A US Treasury can take up to 2 years or 10 years or 30 years to maximize itself fully. So that's why whenever you get kids, it's smart to actually invest in bonds. So then when they are of age, you could cash out those bonds for the principal plus all the interest that you already accrued. Then there's mutual funds. Mutual funds is a basket of stocks or bonds. And you could purchase these. These are kind of like stocks because a mutual fund can be priced at $12 a share, but you can own more than 50 companies in that one share. So stocks are a good idea to invest if you want to be really diversified. The only bad thing is that mutual funds are very specific. So you could have a blue chip mutual fund. You could have an aviation mutual fund, but it's only for those types of industry. What happens is that you become over-diversified sometimes, and you don't even outperform the market. So it's always good. A mutual fund sounds logically great, but you still have to do your research. The next one is balanced funds. Balanced funds is a combination, it's a basket. It's kind of like a mutual fund, except you still have stocks and bonds. So if the stocks go down, usually bonds go up. If the bonds go down, usually the stocks go up. There's a slight correlation. So with a balanced fund, the idea is that you'll grow your money more conservatively. There's some balanced funds that are more active and more aggressive, and there's some that are not as aggressive and they're conservative. Now, both mutual funds and balanced funds can have a fee associated. It could be as little as 0.25% to 3%, depending on what kind of fund you get and what kind of fund you buy. For a stock, you could either use Ameritrade, you could use E-Trade, and for each trade, you pay $7. But there's Robinhood, which is a great app, which you basically can buy stock for virtually free. You just pay for the stock and that's it. That's yours. You want to sell it, you just sell it. And then the last kind of investment would be alternative investments. And alternative investments require a lot of knowledge. You could do futures, you could do options, you could do Forex, which is actually easier to learn. But futures is basically like if I wanted to buy your hat in 30 days, so I'll put down $30, but I'm betting the fact that it's actually going to cost me $28. So it's a derivative and it's a lot more data driven. You have to actually know your stuff to do futures and options. And then there's gold and commodities. So whenever the stock market usually crashes, people always invest in gold. That's why when you hear gold is up today and the stock market is crashing, it's because there's a negative correlation between commodities, which is gold, copper, tin, aluminum. Well, actually, that's the same thing. Aluminium, sorry. And that's why people purchase those. You could also buy cows. You could also buy pigs. You could also buy wheat. It's really weird and very, very strange when you walk past the mercantile building and it's like pigs are for $45 each. It's really, really strange. But you can buy a pig, and they're usually futures or options. You're not buying the pig, you're just buying the contract saying that you will buy the pig, but you never see the pig. It's really, really strange. Finance is fucked up. Alternative investments are high risk but high reward. You can get really rich really quick, but you could also lose a lot. You could, in any investment, you have to be prepared to lose, if not some or all of your principal. The principal is the money you put in. Any gain is anything on top of what you put in. And then lastly is real estate, and that's what I primarily deal in. There is a type of investment called real estate investment trusts. Now normally, normal people can't afford buildings. They just can't. So what a real estate investment trust does is that we buy all the income that we accrued from the buildings. So that would be your dividend. So real estate investment trusts are also a good way to invest your money, but you won't see short-term investment gains. Though if you really want to see short-term investment gains, it would be futures, options, it would be Forex, and it would be stocks. Or you could flip a house. That's actually a thing. Buying a house is an investment, buying a car is not. Because buying a car is a depreciating asset. Each day it gets cheaper, And buying a house gets more expensive the more you own it. Actually, just a comment, my girlfriend lives in Gold Coast. So one of the houses, it's a beautiful house, and it costs $1.5 million. And I checked the last time it was sold. It was sold in 2012 for only $850,000. So in only 3 years, they almost doubled the value of that house. So flipping a house can be a way for you to invest, or buying a condo, buying apartments, because you could always rent it out to people. And that could be another income for you. So that's something that you should expand on only if you have enough capital to maintain it. Because you do need to support the client, to support the renter and everything, but you can do it because let's say if you bought a house and if your wife says, oh, let's buy a condo, and you say, oh, we don't have the money, well, you could actually take an equity loan from your house and put that down on the condo. So if your house is $200,000 and you already paid off $120,000, you could take out 40 grand from what you owed and use it to buy the condo. And then you just rent it out, have someone pay for it, and have it pay itself, and you just keep on paying your mortgage. And that's something that people do. The next one is retirement accounts. Everyone gets old, and everyone can't type anymore. You get arthritis, and you have to retire, and you have to go to Bora Bora and write it off as a tax credit. So retirement accounts are long-term plans. They're long-term investment plans, and there's a variety of them. There's 401ks, which are for private businesses. There's 403bs, which are for public businesses and public domains. Hello. And then there's IRA, and IRAs are both traditional and Roth. And I'll explain what those two are and what differentiates them. So the bread and butter for each retirement fund is an index fund. An index fund is basically a fund that follows the stock market closely. So I'm just going to pass these around. Please do not take any pictures of these, because this is actually my 401k. Actually has my information. So do not take pictures of these, please. But if you could see, I actually diversify heavily in stocks because I'm young and I can take the hit. When you're older, you want to invest in more bonds, because if you invest in bonds when you're older, it's more conservative for you to do that. Because when you're older, you don't want to lose all your money. You don't want to lose all your shit. You don't want your wife to go out and pay for like $2,000 for a Louis Vuitton bag, and you're like, what the fuck? Because when you're old and when you retire, you're living off your Social Security and anything you've saved. And that's it. So what people do in retirement accounts is that they can either passively manage, which is what I do. I just tell the person that owns my 401k, hey, I want this much money to go to this kind of fund. I want this much money to go to this kind of fund. And I don't have to worry about it. I pay a fee every year, and that's it. Probably the fees amount to $45, and it grows depending on how much I have in my account. If you go for an actively managed fund, it's more expensive. So if it's passive, and if you're okay with being passive and not checking it every day, it's perfectly fine that you can do that. The more passive a fund is, the lower it is to own. The lower the management fee, the lower all the associated fees are with it and associated with that, owning that fund. The more active it's managed, then you need research teams, and you need bankers, and you need more people, more personnel on hand, and you're going to be ending up paying for it. Because the bank's not going to pay for it, you're going to pay for it. So for a retirement account, you can make that decision, but what I recommend is when you're young, have the majority of it in stock. You could have it in, like on my 401k, it breaks it out, and it says emerging markets, large large cap stocks, which are larger companies, small cap stocks, which are smaller companies, and I could invest in a whole variety of different types of funds just through my 401k. Now, one of the questions that was sent to me was, should I take out 401k to pay my debt? No, just no. Your debt is with your own money, but if you own a lot of medical expenses, you can take it out. Is it advisable? Probably not. Because every time you take money out of your 401k, you have to pay a 10% tax if you're not over the age of 59 and a half. It's weird and arbitrary, it makes no sense. But you still have to pay 10% regardless. Now, if you just take it out, you still have to pay a penalty on top of that tax. So there are exceptions like paying for your school or paying for a first-time home exception. You could do that. Divorce, that's strangely on there. And military exceptions. There we go, exceptions. So if you're going away and you have to pay for someone to watch the house, pay for someone to watch the dogs if you're living alone, that's something you could take out of your 401k. Do you have to pay it back? You don't have to, but your 401k should only be your retirement account. Next one is traditional IRA and versus Roth IRA. Traditional, all your contributions are tax deductible, which is awesome. You deduct your contributions off your taxes. So basically, you pay into the traditional IRA and you write it off your tax. So you're not paying tax on the contributions of that IRA. But there's a few caveats. You can't hold it on forever. Once you hit 70 years old and you don't want to take out your IRA, well, you have to by law, or else you're going to be penalized. So you have to take it out, and whenever you do take out of your traditional IRA, you have to start paying taxes. With a Roth IRA, that's what they recommend young people to do, is with a Roth IRA. Why? Because you use after-tax money. So any money that you already made from your job, you could just put into a Roth IRA. For a Roth IRA and traditional IRA, you can put up to $5,500 a year, and that's it. That's your max. Or how much you made that year, whichever is less. So $5,500. So it's good for traditional IRA for someone that is older and is hedging that taxes will be lower. Roth IRA is basically saying, I'm just going to pay the taxes now up front, and when I want to retire, I just take it out and I don't have to pay tax on it anymore. This is good because if you have a combination of a 401k and a Roth IRA, you could take money out of your 401k and you could take money out of your Roth IRA, but you're only paying the taxes out of your 401k and you're not being double taxed on your Roth IRA. So that could be a way for you to maximize the amount of money that you get once you're retired. All right, 401k. It is the greatest thing ever invented. It was invented by Johnson & Johnson, I think in the 70s. And back then, they could contribute up to 25% of their money, and up to 25% of their money, Johnson & Johnson will give them. 401k basically means I, as an employee, will give 5% of my annual compensation to this account, and you, the employer, pledge to match me up to 5%. Now, BNY Mellon matches me up to 5%, 5.5%. So if I put 5.5%, they give me 5.5%. That's 11%. 5.5% is free money. It's basically money that they give me. For young people, what they're advising now is 15% of your annual compensation should be stored away, bless you, should be stored away for your retirement account. So what I did is I actually put in 10%, and they give me 5, which makes up my 15. So 401k is fantastic. You should definitely use them. Now the question is, what happens if I want to switch employers? What happens if I get fired? What happens if I want to move employers? Well, you could roll it over. You could grab your 401k from from whatever fund is managing your 401k. You could grab it and put it into your shiny new 401k. Or you could put it into a Roth IRA or a traditional IRA. It makes sense to put it into your Roth though, because you didn't pay tax on your 401k. Why should you pay tax on it again? So put into your Roth IRA. Now there is a small little caveat, which is stupid, but let's say you have $30,000 in your 401k. You want to roll it over to a Roth IRA. Well, the company will keep $6,000. They will keep 20% of whatever you took out as a lien against the tax. Because you might receive that check and you might like it and you might keep it. And they're basically saying, all right, fine, he's keeping it, we're keeping the $6,000 and paying our dues for the tax. Well, to receive that $6,000, you either have to put it in, you have to put it in through your own pocket, or you can wait for the company to put it back in there. But the thing is that sometimes how everything's structured, because you don't have that full amount, because you don't have that full $30,000 in that new Roth IRA, you're going to be taxed 10% on it. So sometimes it's better just to roll it over to a 401k and just continue growing. Don't leave it in the other company. If it's a small amount, sure, but you should try to keep everything consolidated. Boop, 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 boop. All right, and then some other questions that I couldn't really quite fit. Whenever you feel comfortable. I still live with my parents because I hate the idea of renting. I hate the idea of paying for something that I own and use even though I don't own it. So my plan is to save up money and buy a house or buy a condo. And then once I want to move out of that condo, have someone rent it, someone pay for it, and me enjoy my house with my wife and my kids or whatever. And then, no, wife. To be all inclusive, yes, but no. So you can move out whenever you feel comfortable. If your parents are like, you know what, we like you being here, and you help around the house, then you do that if you want. If you're sick of them, move out. It's up to you. But whenever I asked all my professors, what's the one thing you would tell me, and they were like, never, don't move out. If you don't have to move out, don't move out. And that's up to you. If you want to move out, that's fine. The rent in Chicago is ridiculous. It's ridiculous. My girlfriend pays for a studio for like 14 or 15. It's ridiculous. So that's up to your own discretion. Time equals money. Yes and no. Depends. If you're an entrepreneur, yes, it does equal money. But if you're just living your life, then it really doesn't. Unless all you think is money, then it can mean your life. And then there was one that says, if you're really in a sticky situation with debt, who do you trust? So I just said stay away from loan sharks. When you're in a bad situation with debt, talk to your bankers, talk to people that own your debt, and see if you could refinance or consolidate your loans, and just deal with the debt specialist if you can't find a solution. And then one thing that I realized I didn't talk about, or someone asked, was car loans. With car loans, with buying a car, the rule of thumb is never ever settle for the term. So if they say, oh, we'll give you, $400, but you're gonna have to pay it over 6 years. No, give me my fucking 5 years, and I'm gonna pay this much a month. Always make sure and minimize the overall cost of the car. Don't focus on monthly payments. Don't focus on all that. Just focus on the overall price of the car, because it'll actually make monthly price lower. And always try to make your terms manageable, but yet short enough so you're not stuck paying something for a long time. So I'm going to open up the floor to questions. Any questions? Yeah.
Never default on loans or credit cards.
Yeah.
Does that include the payment due date, or does that include like the 30 days after that?
Okay, so the grace period that you're referring to is how long it takes for the interest to be applied to that purchase. When I say default, that basically means don't pass the due date without paying. Now, sometimes you could actually pay your debt on the day it's due. As long as it posts on that day, you should have no problems. So to make sure it posts on that day, always pay before 5 o'clock, and they usually tell you the window of when to pay for it if you want to apply to that day. Yeah?
Oh, so
Yeah.
you said with the 401k, do not pay off debt with the 401k.
Yeah.
But I've also heard people say don't start contributing to your 401k heavily until after you paid off debt. That's not like mortgage debt, so like student loan debt. Would you advise to stay away from 401k until after you pay off student loan debt and focus more on that all first?
Well, most companies will have you auto roll in 401k because they don't want that liability anymore. So they'll have you auto enroll into a 401k, whether you like it or not. Your contributions are yours alone. If you feel that you want to pay off your debt, and if your debt is like astronomically high, then yes, I would advise pay off your debt first, but keep saving money. Because if you keep on spending, you won't save money. So it's always good to practice paying off your debt and saving money at the same time. And then Sam, you had a question?
So you said that once you put money into Roth IRA,
Yeah.
I mean, you're paying taxes now.
Yeah.
So let's say like a president, I'm not going to mention names.
Yeah.
Becomes president and wants to change that rule. Is it possible that laws be changed or not?
No. If they changed it, I would automatically move to a different country. But basically, those laws are in place, and those laws are heavily loved by Congress. So I don't think they're going to change it. Can they change the tax code? Sure, but it basically boils down to where the money originated from. Yeah. Oh, perfect question. So sometimes, like Ameritrade and E-Trade, they make you pay like $7 a transaction. So if you buy $25, you have to add $7 on top of that. If you sell $25, you have to add $7 on top of that. And I think that's kind of dumb. So there's actually a lot of avenues that you could actually pay market price for the shares. So one of them would be, I think it's Loyal 3, I think it is. Loyal 3. There's also an app on your phone called Robinhood. And that one basically, you have it? Hell yeah. And you can basically trade without any fees at all. Another one that's actually pretty good, if you really don't want to think about investing, you could actually download something called Acorns. And Acorns is fantastic. And it basically, so let's say you buy a soda for $1.95. Well, that 5 cents is put into an account in Acorns. Once it has $5, it'll automatically take it from your checking and put it into a fund that you want. And that is completely passive, and I've always recommended it to my friends that don't have the money or capital to start investing a lot, and they say that it's like phenomenal and awesome. You could choose if you want it to be aggressive, as conservative as you want, the kind of track that you want it to be invested in. My friend's been doing it for like 7 months, and she already saved up enough for like $80, and she already made like $20 on that, so like $100. So, and that's just by pennies and cents. And it always rounds up to the nearest dollar for any transaction you make. So that's a pretty cool thing. Yeah.
Oh, you might have already covered this.
Sure. Yeah.
I don't know, did you talk about mutual funds?
Yeah, I did. Yeah.
Oh, okay. Well,
I mean, you could ask your question.
so would you rather do mutual funds to start out, or would you rather go like individual stocks?
Well, for mutual funds are, you already know what a mutual fund is, right? It's a basket of stocks. And it usually has one strategy, like all blue chip, all education, all basically one industry. the good thing about that is that you could diversify over a lot of stocks, but at the same time, you're only diversifying in one industry. So mutual funds are good, yes, but you should do your research. One alternative fund is called an index fund. No, not an index fund, a balanced fund. Hold on, I have actually an example here. Hold on. Oh, I didn't show them this part yet, so. There we go. Shit. There we go. Whoa. If it was meat spin, I would actually applaud that. Oh, what the hell?
You have to enable editing.
Oh. There we go. I'm showing my age now. Okay, so this is a balanced fund. This is a balanced index fund. So Morningstar is my favorite. I use them to like research any fund I want. So from here you could see that, so the NAV is basically just the price, the share price. So it's trading at $3.77. Total day return is down 0.42%. And so far, it tells you total assets. So this fund itself is $29.4 billion. The expenses is 22%. So 22% of your account is their fees. So, I mean 0.22%, not 22%. Jesus, no, 0.22%. So it's low. It's low because it's below a percentage. So it's something very good. Minimal investment, you need $3,000 to open an account with them. Some of them, they do have minimums, some of them they don't. So you just have to research which ones. Now for a balance, just to give you an idea what it means, so the blue line is this fund, and the green line is the target risk for Morningstar, which is basically what they would like to see. So this is actually performing above than what they want to see. And your allocation is, so your allocation when it means 50 to 70% equity, whenever you're investing means stock. So this is investing in 50% equity up to 70% equity depending on how the markets are. So here it'll actually tell you what it owns. So it owns a bit of Apple, it owns a bit of Microsoft, Exxon, Johnson & Johnson, and Amazon. And then it shows you the bonds. What kind of bonds, what kind of corporate bonds. So it shows that percentage of assets in top 5 holdings is 5.3. So you could use that to see how heavy, basically how much those companies are weighted to the overall fund. And then down there it tells you what sectors to be. So that would be something that I would invest in, is balance funds. That's what I try to replicate with my 401k, is basically this fund. Any at all? Yeah?
Is it best, like if you have a payment of any sort, is it best to just pay it, you have the money to pay it all up front, or if you kind of section it off?
If you have the money, pay it off. So how you saw the FICO score? Basically, it looks at your total debt. So if you take $300 off your total debt versus $600 off your total debt, $600 wins. So if you have the money to pay it off, pay it off. So the goal is to have 0 debt. So just pay it off when you can. Credit card should always be one of the priorities since it has a higher interest rate typically. And then the rest you can allocate in budget for. So, or whatever your budget allows. Yeah, Sam?
Oh, okay, so let's say you're flipping a house, right?
Yeah.
And I buy a condo and someone else made the house.
Yeah.
Do I have to, how do I flip it exactly? Is it just,
Oh, you mean like, what do you mean by? Like the income that you get from that house?
Yeah, right.
Yeah, it would have to be,
Like the tax guy.
yeah, you would have to go to a tax guy with that. Because you wouldn't do, I mean, you would do your 1040, but you would do more than that. You would have to do, oh, what's it called? It's like a, huh? Yeah, it's a 1919. You have to do a 1919 for assets. Yeah. So. Is that a question that you want to see about how to do taxes? Or?
I mean, I know how to do them. I think the final thing is kind of simple, but
Yeah.
you know, in case I do,
Yeah. I mean, to be honest, like, you should really not hire a tax person until you have, you know, multiple assets. If you have a lot of income that's not your main job, because you could just buy TurboTax and you just file it, and it's really simple.
I think you guys should do a triple tax acting. I'll do a session for you guys.
No, or just pay everyone's taxes. I mean, no, not pay, but like do, and then they give you a fee. No, you don't. No. One of my coworkers, he does taxes on the side. He just charges like $120, and then people do it. And unfortunately, people pay him, but you know, his game, because you can learn how to do your taxes. It's very simple, but if you don't, you could always pay to have someone else do it. That's something good. If you know how to do TurboTax, always be the one from your friends. Say, you know, I'll do your taxes for you. Yeah.
This might be really simple. I'm not sure if you covered this
Sure.
beforehand, but so like, I don't know, like, I just have never felt the need to like get a credit card.
Yeah.
I feel like I know people who like had them for years, so I always feel like, well, like why do that if I can just use cash and debit?
Yeah.
But like, is that viable, or like why get a credit card? Why go credit?
Do you want to get married?
Probably, yeah.
Okay. She's probably going to want a house. No, I mean, to be in a world without credit is kind of scary. You can pay everything with cash, and that's fine. But sometimes you don't want to put that much stress on your own personal finances that you'll have a credit card. Now, I understand that you don't want to get into debt, or you don't feel the need to use a credit card because you can just pay off everything. But then my only answer to that would be, what happens if you get a credit card and you pay something with the credit card, and then you just pay off the credit card as soon as you pay for it?
Free credit.
Exactly. Yeah.
What about whenever you use credit, like you're like what about that identity stuff? Like if like somebody needs your identity from the credit card and then like start taking purchases and all this stuff like that.
Well, most credit cards have protection on top of the credit cards, so they'll. A great thing was, annoyingly, when I was in. Actually, no, my girlfriend actually. This happened to her more recently. We went to Vegas, and she has a Wells Fargo account. And so we went to Vegas, and she was gonna go pay for something, and it didn't go through. Didn't go through at all, and it was a debit card. It wasn't even a credit card, it was a debit card. So she calls and she's like, what the hell happened? And they're like, oh, you're in Vegas. And that's it. That's the only explanation they gave her. So I used my credit card and my debit card as long as I wanted to in Vegas, and it was fine. But because Vegas is basically, you know, somewhere where you would go to spend money, they look at that higher. Like, if you go to like Galena, they're not gonna care. If you go to like Vegas, they're gonna be like, oh, he's in Vegas, it's like a higher risk area. So some credit card companies do look and monitor at what you purchase, and they'll shut it down completely if they think that's not where you are. So sometimes when you do travel somewhere, always call them and say, hey, I'm going here. Now, with the identity theft, unfortunately that does happen, and that's something that you should actually look at your credit report, because your name could be Alex Bryan's, and there could be another one, like sitting over there, that you don't even know, and he could actually have your debt, or you could have his debt. or you could have his bankruptcy. And it's really, really messed up, but that actually happens a lot, like a lot. I already forgot the statistic for it, but it is something that actually happens. So it's better that you look at your credit report and actively be in control of your credit. And then if you do realize that something happened, unfortunately, it could take a long time to get that off your credit report. But in the end, if you successfully get it expunged, then you'll be fine. And you'll be liberated from whatever was messing up your credit report. So there are outlets to identity theft. As long as you keep a good relationship with your bank, as soon as your credit card is taken away, as soon as you make a purchase that's not yours, always call the bank and just say, hey, this is not me. So, any other question? Oh, what is it, Sam? Got one. Anything? Yep.
So for someone like our age,
Yeah.
18, 19,
Yeah.
20, would you say it's better to invest in mostly short term or long term?
I would say, well, it depends. If you really want to see, if you really want to pay off, some nice Jordans right now, you could do short term. You could do Forex, you could do day trading and everything like that. And you can do it, but you just realize that that's high risk because there's a lot of high reward. For long term, it's basically once you just want money in an account and just don't want to worry about it. So for you guys, I would say both. Try to invest and try to keep an investment account, and let it grow so you get that notion of saving for your retirement. And if you want, you could also day trade at the side. Because now it's getting more expensive to retire, unfortunately. And Social Security might run out, it might not, depending, especially if they're going to do tax cuts. And yeah, so you should look at both. So yeah. Yeah, you're fine.
Just your personal opinion, what do you think on like assets versus equity, like percentage-wise, like how much you would spend on either of them? If like, if you want to own a condo,
Yeah.
maybe spend 10% of my income on the condo and then like 20% on equity, 1% into stock, that kind of thing.
Yeah.
What would you think?
It all depends on your budget. If you're going to buy a condo, I would highly recommend that you don't buy it unless you have 20% of the total purchase price. Reason why, it's ridiculous, but if you want to buy a $200,000 condo, you have to save up 40 grand just to put down. The reason why I say this is because you could put down 3% and you could have it, and you could own the condo, but you'll pay an additional $200, $300 called PMI, and that's basically private mortgage insurance. And why should you pay the bank money for money that you're using, even though you're paying it back? So I would first invest in stocks now, and then once you have enough equity to purchase that asset. Yeah, because you don't want to pay more than you need to, because you're already going to be paying a lot of money to that mortgage. So with that extra $200, you could actually use it and invest it in stocks. So, yeah.
How do you start putting money into a Roth IRA?
You have to open it. So you could open it through Fidelity, Vanguard. What's another one? I just had one. Charles Schwab's, Edward Jones, or some of your banks can actually have them as financial products. So you would just have to shop around which one has the best management fees, which one will tend to you, what kind of investment you want, either passive or active, and just shop and compare. In the end, it's your money, and you should have every say of how it's managed. So there's no such thing as a dumb investment unless it's not research, or it's not, if you didn't do any research, then I think it's a dumb investment. As long as you put time into knowing what you want to do and what you're going to put your money in, then anything is a smart investment.